All right, let's dive right into this explainer and map out the massive global economic dominoes that could literally impact your own investments. Today, we're unpacking the powerful, kind of hidden undercurrents that are moving global wealth right now. We're going to track everything from the absolute foundations of our economic system all the way to the silent wrecking ball of the US dollar, and ultimately, how you might position yourself to weather the storm. It's a totally fascinating journey of cause and effect, so let's get started.
We've got a brilliantly structured roadmap for this explainer today. First, we'll look at free markets and trade-offs. Then, number 2, the dollar wrecking ball. 3, private credit, systemic risks. 4, the boomer demographic shift. 5, the pair trade strategy. And finally, number 6, the outlook for precious metals.
So, Section 1, Free Markets and Trade-offs, Establishing the Economic Baseline.
You know, the economist Thomas Sowell once made this really profound observation. He said, "There are no solutions. There are only trade-offs." And that brilliantly anchors our whole argument today. When we're analyzing global macroeconomics, we really shouldn't be looking for some kind of utopian fix, right? We're just looking for the least bad strategy. The reality, as our source material points out, is that every single policy, every intervention, and every market dynamic simply comes with a cost.
The source actually contrasts these economic models using a pretty striking biological analogy. Think of free market capitalism a bit like a pride of lions. It's actually strengthened when the weakest are left to fail, because that ensures only the strongest genes survive. By basically refusing to bail out poor decisions, the market theoretically builds a much stronger foundation. But contrast that with interventionist or socialist models, where governments step in, pick winners, and prop up failing companies. When a system refuses to let bad companies go bust, well, the entire economic gene pool essentially weakens over time.
Okay, moving on to Section 2, the dollar wrecking ball, the global engine of currency. 162. That number represents the recent, honestly staggering exchange rate of 162 Japanese yen to a single US dollar. Now, a lot of Americans might just hear that and think, hey, cheap vacation to Tokyo. But the source material urges us to look much, much deeper. This number actually represents a massive, slow-moving crisis for net importing countries all over the globe. So you're probably wondering, why should the average American care if some foreign currency is collapsing against the dollar? I mean, it's really easy to look at a strong dollar as a purely positive thing for us. But in our completely interconnected global economy, a currency that gets too strong actually acts like a wrecking ball to our trading partners.
To really grasp the severity of this, we kind of have to completely reframe how we think about money. Dollars aren't just assets, they're actually liabilities. Since they're loaned into existence by banks, it creates this constant built-in future demand for more dollars, literally just to pay back the principal and interest on global debt. And because of this massive structural demand, countries like Japan get caught in a vicious cycle. They desperately need dollars to buy basic everyday commodities like oil, which of course is priced in dollars. So as the dollar gets stronger and stronger, it takes way more of their local currency to buy that exact same barrel of oil. That effectively destroys their local purchasing power and forces their governments to intervene.
And that brings us to the ultimate domino effect. If foreign economies are getting pushed to the absolute brink by this dollar wrecking ball, how do they defend themselves? Well, they have to get their hands on US dollars. And to do that, they're going to be forced to liquidate their US assets. We're talking about selling off US treasuries, commercial real estate, and US stocks. This massive forced selling, it would bring their local crisis straight to our shores, literally pulling down asset prices right here in America. Which leads into Section 3, private credit systemic risks, cracks in the domestic foundation. Because listen, it's not just foreign nations struggling with dollar liquidity. There are massive domestic sectors right here facing a very similar crunch. The source material points to private credit as this opaque, black box sector where true asset values are dangerously hidden from the public. Unlike publicly traded stocks where, we can see the price of a share second by second, private credit operates totally out of sight. It relies heavily on internal valuations, which basically means taking the fund manager's word for what an asset is actually worth. And that can really mask underlying distress.
Let's walk through these specific risks for a second. Because of that lack of transparency, if investors start sensing trouble and rush to pull their money out, we could see a sudden, massive spike in perceived counterparty risk. If confidence drops and major funds just halt redemptions, the circulation of money simply stops. Banks stop lending to each other, and credit completely dries up. This fundamentally threatens to trigger a vicious liquidity crisis, really echoing the 2008 credit cycle, where a total lack of trust freezes the entire financial plumbing of the economy.
All right, Section 4. The boomer demographic shift. Unplugging the mindless robot. $90 trillion.
That jaw-dropping figure represents the estimated net worth currently held by the baby boomer generation. It is just a staggering accumulation of wealth. For the last few decades, this demographic has basically been blindly pouring a portion of their paychecks into passive index funds. They've acted as this massive, automated buyer that's been constantly supporting the market.
But now, we are facing a terrifying reversal of that passive bid. As the source breaks it down, this happens in 3 distinct steps. First, boomers hit retirement age and their earning years come to an end. Second, because they aren't working anymore, that automatic, mindless purchasing of S&P 500 index funds just stops. And finally, step 3, they actively transition into the distribution phase, meaning they start selling off those very same assets to fund their day-to-day retirement lives. The biggest buyers in the history of the stock market are actively transforming into its biggest sellers. That is a massive headwind that's going to weigh really heavily on equity prices.
So, Section 5, the pair trade strategy, navigating the bubble.
With all of this going on, how do you actually invest during such extreme uncertainty? Well, this is where George Gammon's pair trade strategy comes into play. Outright betting against a market bubble is incredibly dangerous, mostly because irrational markets can stay irrational for a really long time. So the strategy here is taking a short position, betting against, a fragile sector like the housing market, via builders like Lennar, which are super sensitive to economic downturns. But to protect yourself, just in case the market decides to keep melting upward, you simultaneously hold a long position in the S&P 500 as a hedge. This way, you're actually trading the difference in performance between the two, rather than just taking a naked, directional bet on a highly unpredictable market.
And finally, Section 6, Outlook for Precious Metals, the ultimate protective asset.
When traditional paper assets start looking risky, where do wealth preservers actually turn? Well, despite some recent technical damage and, frankly, highly volatile charts, the financial advisors from our source material are strictly maintaining their bullion allocations. They're targeting roughly a 10% allocation spread across physical gold, physical silver, and miners. See, they don't look at precious metals as a trade to jump in and out of based on short-term price action. Instead, they view it as a foundational protective layer of a portfolio. It's meant to withstand exactly the type of systemic shocks we've been talking about today. And history definitely proves why holding firm is often the right move, because context is everything, right? Look back at the 1970s, silver dropped roughly 50% before rocketing to historic highs. Or look at the 2008 financial crisis. Both gold and silver plunged severely, right alongside equities, only to rebound and hit massive peaks by 2011. The present period is seen by the source as a prolonged phase of base building and technical testing. It's a necessary, even if it's painful, setup for future strength.
So based on everything we've unpacked in this explainer today, from the vulnerability of global currencies and those silent risks in private credit to unstoppable demographic shifts and the sheer need for structural portfolio protection, you really have to ask yourself, how insulated are you, truly, from the next swing of the economic pendulum? The dominoes are already lined up. It's completely up to you to decide where you're standing when they start to fall. Thank you so much for joining me on this deep dive. Keep learning, keep questioning, and I'll see you in the next explainer.